Hi, I'm Grant Stephen.
And I'm Chris Bernier.
And we're the two investment guys. This week, Chris and I wanted to talk about a couple of things that are fairly topical right now, one being the Canadian dollar and the other being, the U.S. stock market rally. But first, we wanted to have a look at index returns from around the world. And we'll start in Toronto, which is down 1% so far this year. In contrast to the U.S. markets, the S&P 500 and the Dow are both up about 16%. And when we look to Europe, we see London's up about 10%, France is up about 5%, and Germany's up about 6%. The Asian markets, we've got Japan up 39%, but Chris, that's a fairly unusual set of dynamics there. And Hong Kong, which is a bit of a proxy to China, is down 8%. Now what we've seen is short term here, markets have adjusted slightly anyway to the increasing bond yields that we've seen in the U.S. in, say, the last 6 or 8 weeks. And that's had an effect on the Canadian dollar, and Chris and I wanted to talk a little bit about the Canadian dollar today. So Chris, why don't we just have a look at what's happening there?
Sure. Well, if we look at the equity markets, there's been a divergence in Canadian and U.S. equity markets actually for a couple of years now. And if we think about Canada for a moment, it's a very dominant resource-based economy, and demand for resources globally has waned somewhat. So that has had a negative impact on the outlook for the Canadian dollar. Other things going on in Canada, weakening housing market, we've seen trade and budget deficits, and in the U.S. predominantly rising bond yields, and Canadian yields have risen a little bit as well. If we look at what's going on in the U.S., stronger economic growth outlook, and so more money flowing into that market has also pushed the U.S. dollar up at the same time.
Right. So here we sit roughly 95 cents compared to, basically par a couple of months ago. So quickly now, if we turn to the U.S., we get a lot of questions on what's actually driving this U.S. stock market rally. And we wanted to drill down on a couple of really important things. First of all, the earnings that are coming from these companies, unprecedented levels. A unit of the S&P 500 earned $85 in 2007. It's now $100 per unit. And when we compare that to the low inflation that exists, these profits are at multi-decade highs. We've got a situation where payout ratios, that's how much money the company shares with shareholders, the long-term average is about 45%. Well, today with all this increased profitability, it's down to 32%, so there's room for that to grow, actually. And cash balances are at record highs, and these price-earning multiples are really right in line with long-term averages. So we actually think the market is probably where it should be, give or take a little bit.
For sure, and if we look at the demographics, we're still at the early stage of baby boomers retiring, low interest rate environment. People are looking for yield, for income to support their retirement. This trend is probably likely to continue. I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. Chris and I are going to pick up on our discussion around market dynamics. So until then, I'm Grant.
And I'm Chris.
And we're the two investment guys.